Hello everyone. So we are back in chapter number 4 of economics, that is banking and monetary policy. In our previous video, we started this topic and discussed about the measurements of monetary policy. There are two kinds of monetary policy instruments, quantitative and qualitative. In our previous video, we discussed two quantitative measures, those were bank rate and repo rate and reverse repo rate. Today, we are going to discuss the rest of all those quantitative measures. So here we start with stabilization, which is called marginal standing facility in technical words. As we saw in repo rate, that whenever a commercial bank needs to borrow fund from Reserve Bank of India, it will sell its securities to Reserve Bank of India with an agreement to repurchase them at a rate that is decided by Reserve Bank of India. So wherever in case of shortage of funds, commercial bank require funds in emergency situation, it will obviously borrow those funds from Reserve Bank of India, because one of the major characteristic of Reserve Bank of India, as we all know, that it is called bankers bank. So as RBI is bankers bank, it will definitely lend the money to the commercial bank, but this time whenever it is required in the emergency situation, it will charge a little higher rate than the rate that was in repo rate. So that is called marginal standing facility, which is always higher than what is the repo rate. So as you all can see here, I have mentioned different rates which we will be discussing at the end of this video. So this is called the stabilization. In case of shortage of funds, when commercial bank borrows money from Reserve Bank of India, it will obviously lend that money but at a higher rate than the repo rate. That is called stabilization. So this was third measure. Fourth measure, which is cash reserves ratio, which is one of the most important topics, and I also told you this, that we discussed about CRR when we were discussing about the credit creation in that video. So as you all know now what is credit creation, this will seem easier to all of you. Cash reserves ratio is simply a rate at which commercial banks are supposed to keep reserves into their vaults. So whenever a deposit comes into bank, a bank will divide that deposit into two parts. One will be reserved and the other will be used to lend it to the needies. So keeping reserves out of the deposits, previously when this rate was introduced, there were two partitions of these rates. Previously CRR was divided into two parts. That is, one is demand deposit, another is time deposit. Demand deposits are those deposits which are repayable on demand. Like if I am holding a savings bank account, I can withdraw that money any given point of time. So that means that whenever I demand my money back, a bank will definitely pay that money to me. So that is demand deposit, and this is time deposit, which will be matured at a given period of time. So 5% of all those demand deposits and 2% of those time deposits are supposed to be kept as a reserve. Right now, there is a uniform rate which is applicable to all kinds of deposits that are prevailing in the bank. So this cash reserves ratio is basically that rate of reserves at which a commercial bank is supposed to keep its reserves out of all those deposits that it is holding. So this is cash reserves ratio. In case many customers withdraw their money at once, banks can have sufficient funds to return. If you remember the table that I drew on your credit creation, you must remember that out of 1000 deposit, bank created 4000 additional. So why that was 4000? Basically, if you total out that, it will come to 5000, but that was divided into two parts, 1000 and 4000. So 4000 and 1000. So that 1000 which was remaining as a reserve, that is used to repay the balance in case of any withdrawal request. So if any customer comes to the bank and requests to withdraw the money that he is holding in the bank, a bank can return that money out of that cash reserve ratio. So this is basically kept as a reserve to keep the sufficient fund to return that money which which is requested for the withdrawal. So this is cash reserve ratio. This is used to control the inflation. How? We will come to it later when we will finish off this statutory liquidity ratio. So these were the two instruments that we just discussed: the stabilization and cash reserves ratio. Cash reserves ratio is also something that you must be aware already, because we have already discussed about the credit creation in our previous videos. So statutory liquidity ratio is our next topic. Statutory liquidity ratio is also one of the provisions that is given in the RBI Act, that a bank has to keep a minimum percentage X. I have written X because these rates keep on changing. Minimum X rates or more of all the deposits in the form of cash, gold and unencumbered securities. So let's just take an example, that if a bank is holding 1000 rupees as its deposits, so bank is supposed to keep it. For example, if we take that this rate is 10%, so bank is supposed to give 10% of that 1000 rupees, that is 100 rupees. So that 100 rupees is required to be kept in the reserves in the form of cash, gold and unencumbered securities. Unencumbered securities means those securities which are free from any burden. So those securities which are not given as a part of mortgage or as a part of lien or any other kinds of encumbrance is not there on those kinds of securities. So out of those 1000 rupees, these 100 rupees will be kept as a statutory liquidity ratio or statutory liquidity reserves in the form of these three things: cash, gold and unencumbered securities. Now both of these reserves, statutory liquidity reserves and cash reserves, both of these reserves are used to control inflation or to get the economy out of the deflationary situation or depression situation. So how does this thing work? Let's take both these scenarios. Firstly, in the case of inflation, what will government do? It will simply raise the CRR and SLR both. So statutory liquidity ratio or cash reserve ratio, both are to be increased. So in that situation, there is higher CRR and higher SLR. So you all are aware about this thing, that when these ratios are higher, banks will have to keep more as reserve. So it will definitely be having less amount to lend it to someone. So that means more reserves, less loans. So if people are not taking enough loans, it will definitely be a situation that there is a shortage of money in the market. So lesser money in the market, there will be lesser circulation in the market. People will not demand those goods which they are not requiring. So by doing that, money and supply both can be curtailed. How does this exactly work? We have discussed this many times before, so we are not going much deeper into this. So this is how higher SLR or higher CRR work. This is why I have merged both these topics, because both of these things work in the same way. And there is one thing: lower SLR and lower CRR, there will be lesser reserves, there will be more loans, better money circulation in the market, and this is how they will get out of the depression situation. So this is how government or RBI use these things to control the inflammatory situation or depression situation. So to control inflation and depression, government uses statutory liquidity reserves and cash reserve requirements. How does it work? We have discussed about it. So these were the three instruments. Now moving on to the fourth one, that is open market operation. Here this word is the most important, which is called open market. Open market means in that situation, Reserve Bank will go to the open market to purchase or sell. Both of these things I have mentioned here: to sell or purchase the government securities that it is holding. So it will go to open market, and in open market means in that market in which we are also prevailing. So we are also able to purchase or sell the government securities from Reserve Bank of India. So when government or Reserve Bank of India purchases the government securities out of the market, that means that Reserve Bank of India is dumping over the fund that it already has in the market, and this is how it will increase the supply of money in the market. And in the vice versa situation, means in the reverse situation, Reserve Bank will sell those securities to get the money back. So in that situation, decrease in the supply of money in the market will happen. You must be able to understand this, that if Reserve Bank of India is purchasing securities worth ₹1,000, it is purchasing, that means it is depositing 1,000 rupees in the market, and in the reverse situation, when government is selling the securities, it will get that money back from the market. And this is how increase and decrease in the market happens. And what happens when there is an increase the money supply and what happens when there is a decrease in supply of money, and why RBI needs to do this. We have already discussed about these things in our previous videos. That increase in supply of money and decrease in supply of money, this happens when inflation happens, and this happens when there is a depression situation. So in case of depression situation, government will increase the supply of money to get the circulation of money, to get the flow of circulation of money smooth in the market. And then this is the last point, that is called sterilization. This point is related to the foreign exchange reserves that is happening in the market. When foreign exchange boost means excess inflow. Excess inflow means inflow which we was not expecting in the economy. When this happens due to trade or foreign investment, either there is trade happening, that means either we are exporting something to the foreign countries or they are investing in our companies in India. When there is excessive inflow in the economy, Reserve Bank of India will sell the government bonds, and in the case of foreign exchange excessive outflow, Reserve Bank of India will purchase the government bonds. Purchase and sell, you are already aware about these things, but why does it need to do this? Because there is an excessive inflow, means the inflow that we are not expecting. So to balance these things, the government will sell. When government sell, there is a decrease in supply of money, because there has already been excessive inflow of money out of the foreign countries. So to balance the sheets of government treasury, Reserve Bank of India will either purchase or sell the government securities according to the market situation. So these were the 7 quantitative measures of monetary policy that is prepared by the Reserve Bank of India. I have mentioned here 5 kinds of rates that we have discussed. These rates are the prevailing rate. These rates are the current rates in the market. On the date of 30th June 2021, repo rate happens to be 4%. That means that in case of situation of repo rate, in case commercial bank is borrowing funds from Reserve Bank of India, it will repurchase all those securities at the 4% rate. That is called repo rate. Reverse repo rate, that is 3.35%. That 3.35% means when RBI borrows funds from commercial bank, it will get its securities back or repurchase those securities at the rate of 3.35%. Then MSF, that is marginal standing facility. As I told you that marginal standing facility is always more than the cash reserves ratio. So cash reserves ratio is 4%. Marginal standing facility, MSF is always higher than repo rate. So repo rate happens to be 4%, and you can see that MSF happens to be 4.25%. That is obviously more than the repo rate right now. Then CRR, that is 4% right now, cash reserve ratio, 4% of uniform rate. I told you that uniform rate means 4% of all the deposits that are in the commercial bank. So it includes demand deposit and time deposits both. And lastly, SLR, that is statutory liquidity ratio, and statutory liquidity ratio is 18% right now. So in this example, if government in this situation, according to the SLR policy, a commercial bank has to keep 18% of these 1000 rupees as cash, gold or unencumbered securities. So this was SLR. So here all the quantitative measures, and in the upcoming video we will be discussing about the qualitative measures of Reserve Bank of India's monetary policy. So I hope you are all aware about these quantitative measures by now. We have already discussed these 7 topics. If you are having any doubt, you can contact me. Thank you, and we will see you in the next one.